want to be where people are moving to. And obviously, you understand why it's important is because they're following jobs and opportunities. And if without people, without jobs, you have no income. And then welcome to Keeping It Real Estate. I'm your host, Dan Brisse, and today we're going to dive into the most important details of finding the perfect market to invest in. We're going to look into what to watch out for so you can be more aware of spotting red flags. So some of the most important things in a market selection, imagine having, the perfect property, but it's in the wrong location. It's kind of like having a fish that's out of water. The right market selection is everything. The right market selection is going to lay the foundation of investing, and it's going to determine the success of your investment. It doesn't matter what you paid for the property. If the market falls out and your residents leave, the value of your asset is going to go down. The market really acts as a buffer against the economic downturn, and it just really helps mitigate risk. And it also opens the doors for maximizing profits and steady cash flow, because if you have the demand, your cash flow goes up, you have consistency, and value goes up. So now the question is how do you select the right market? And how does the economy play a crucial role in that? And I'd consider three pivotal indicators to start. Number one is job growth. You want to aim for markets with diversified job sectors. And why would that be? A mixed job environment means less vulnerability. We bought an asset in a market that was very dependent on one major economic driver. And when that driver went down, oil, we saw pain. Whereas some of our other assets that were in majorly diversified locations, those values stayed steady at the exact same time and went up massively. Number two, population growth. You want to be where people are moving to. And obviously, you understand why it's important is because they're following jobs and opportunities. And if without people, without jobs, you have no income. And then you want to also focus on the local economy. It's essential to know the dominant industries. For instance, cities reliant solely on tourism might be hit harder in an economic downturn than something like a mix of tech, education, and healthcare sectors. The real estate market trends are your compass. So some of those real estate market trends include price history. You're going to want to understand if the property's prices are stable or if they've seen some consistent appreciation. You want to be in those types of markets, especially for your first couple deals. Don't go swinging for the fences on a very volatile market and get caught in a tough situation. You also want to look at vacancy rates. A low vacancy rate can hint at a thriving rental market. If low vacancy, it means high demand. And supply and demand control everything. So get clear on what your vacancy rates are in that submarket and in the market as a whole. And you want to use those vacancy rates in your underwriting. And let's just say the vacancy rate in a market, I remember in Minneapolis, St. Paul, the vacancy rate was like 5%. You might want to use 8, just a little buffer. Try to use something higher than what they're projecting to give yourself a little bit of room, just in case things go sideways. Number 3, you want to look at inventory levels. Remember, again, it's about supply and demand. So if demand is high and supply is low, prices often increase. It's a simple game. Now, not all markets are easy to penetrate. Some barriers that you might have to get through are going to be land availability. Cities with limited land might have higher property values due to scarcity. I know there's city limits that confine how much buildable space there is. Number 2, regulatory environment. You're going to want to know the local rules. Areas with strict zoning laws or building codes might be hard and costlier to develop. And then competition. Too many investors in one market can thin out the potential profits. And what we've seen in that is you've got 18, 20, 30 offers on one deal, massively pushing the value of assets. And that can happen in very strong markets. Now, if you're eyeing the rental market, some dynamics to dive deep into would be rental yields. So you want to compare potential rental income to property prices to estimate your return on investment. So comparing a potential rental income to your price, that's going to come down to underwriting. If you don't know how to underwrite deals, you're going to want to take some classes. You're going to want to get a spreadsheet. You're going to want to work with somebody who has done that in the past so you can get a feel of what your rent will give you versus your cash on cash return. Tenant demand. Is the area popular among families, students, or young professionals? You just need to understand your audience. When you're buying a business like this, you got to know who your customer is. If you're not clear who your customer is before you buy, you're probably buying before you should be. We're buying a deal right now. There is a definite demographic we're targeting, and we're setting up our business plan to serve those residents' needs. Number 3, landlord-tenant laws. You're going to want to ensure that you're well versed with the local regulations to prevent potential future disputes. Are you in a landlord-friendly spot or are you in a tenant-friendly location? And if you are, you just got to take that into consideration in your underwriting before you buy the deal. Infrastructure, they say, is the backbone of market viability. Some of the infrastructures to prioritize is going to be transportation. Is there good connectivity that can boost the property demand and value? And it simply is, can people find your property? Is easy to get to and leave to as far as their work goes. Education, families often flock to areas with reputable schools. You're going to want to understand what level of rating your schools are in, or the ones that your residents are going to attend at the elementary level, middle school, and high school level. And is it a college nearby? You're also going to understand healthcare. You're going to want to have access to quality healthcare, and it can be a major selling point as we have more folks aging and using more healthcare in our society in America. Always keep an eye on the future as well, you guys. You got to stay informed about upcoming projects. Infrastructure developments or new businesses can elevate property values, and the same can go the other way. If you've got a big business that's now leaving, you got a lot of markets and locations in California where there's a lot of big businesses are leaving and they're heading to Texas or they're heading to Florida where it's more business friendly. Also understand the urban planning. You got to understand some of the city's long-term plans that can be an indicator of areas poised for growth. Lastly, tax incentives. Some cities lure in investors with tax breaks, and they lure in business owners. And these can be significant and they can massively boost your return on investment. Always know that safety is first. That's the first and foremost thing to be considering. You got to consider the crime rates and your neighborhood data. You got to understand the safety, the profile of the specific neighborhood you're buying in. Understand what kind of client you're going to attract based on how safe it is. And this can impact your value. High crime rates can deter potential renters or buyers, or quality of renters that you want to rent in. D locations, war locations, they are going to be so challenging to manage. And our advice is just steer clear of those areas and don't bang your head up against a wall trying to figure it out. And then community initiatives. A proactive community can sometimes turn crime rates around in an area. So if you've got a community that's coming together and bringing the folks together, it may help the submarket turn. Mother Nature, while nurturing, can also be unpredictable. And you got to equip yourself with knowledge about history of disasters. Is their area prone to floods, fires, or hurricanes? Florida is an incredible market for job growth, but every single year lately, you're hearing about these hurricanes, and insurance affects these hurricanes massively. So if you're buying in an area, you've got to know how to underwrite to what's been going on and what is coming. That really hits on insurance implications. Areas with frequent natural disasters might have higher insurance premiums, just like I said with Florida. And then any sort of mitigation measures you can take. Is the local government proactive about disaster management, or do they kind of let it fly by the seat of the wayside? Let's not forget some of the softer aspects while we're talking here for culture and lifestyle factors. You want to check for lifestyle and amenities. You want to know the availability of entertainment, dining, recreation. That can all influence demand massively. Maybe you want to understand better culture diversity. A diverse neighborhood might attract a wider tenant base. What kind of tenant base are you targeting? Again, when we're buying a deal, we're going to already know before we close the deal what demographic we are serving. And you want to build your business plan to serve that demographic. And then lastly, community engagement. Areas with frequent local events can suggest a strong sense of community. You have local events where people are getting together, and it makes the community stronger and more robust. Last but not least, networking. You want to be clear on local real estate professionals and networking events. Always leverage insight from the local realtors. Now, they often have their fingers on the pulse of the market, and they know which areas are hot and which are not, especially when you're coming into a new market. Utilize these team members. This is all they do. They probably live there their entire lives, and they should be able to help set you in the right direction or help you steer clear of a red flag zone. Consider joining local investor groups. We do these all the time. We're in a lot of investor groups, and these forums provide valuable exchanges, inside scoops, and potential partnership opportunities. And I can tell you right now, we've created some great partnership opportunities for folks that were local. They brought value, we brought value, and it was a great synergistical relationship. And then lastly, you got to understand the property management scene. This is so big, especially if you're considering investing from afar. They'll be your eyes and ears on the ground, ensuring your property is well tended and profitable. And these property managers are just a wealth of knowledge. Not only have they been local and probably these folks have lived there, but they might be managing your competitors. They may have managed the asset you're looking at buying in the past. It's amazing how many times we buy a deal and we talk to a management company and they're like, oh yeah, we managed that property 3-4 years ago or 8 years ago. So tune in with your property management company right out of the gate. And just to wrap up our discussion, bringing all the information together, a great investor doesn't just collect information, but you have to weigh it all carefully. It's about a holistic assessment to make informed decisions. And you've got to make these decisions before you buy the deal. You have to be able to see the future. And as you do this more and get more comfortable with your underwriting, get more comfortable with submarkets, you'll be able to get a feel of what's likely coming. A smart diversification strategy involves not putting all of your eggs in one basket, but investing in multiple markets. It spreads the risk. And remember, markets evolve. So ongoing research is paramount. Don't just do the work until you close and then check out. You have got to stay connected. Thanks for tuning in to Keeping It Real Estate. We hope you enjoyed this episode. Don't forget to leave us a rating and review if you get value from this show. We'll see you next time.